Hello and welcome to the Deribit Deep in the Money Options Podcast. On this show, we talk to the most interesting people in all of crypto and trading. And while our focus is mostly on options and volatility, we also explore anything that is relevant to the crypto ecosystem as a whole. Today I'm talking to Roshun Patel. Roshun is VP of Lending at Genesis, a prime broker specializing in digital currencies. Last year, Genesis facilitated over $45 billion worth of transactions. So it's safe to say that Roshun is one of the most interesting people to talk to when it comes to institutional involvement in crypto. I hope you enjoy this episode, and let's get right into it.
Hey, how's it going? Paul, thanks for having me on the podcast. Just a quick intro on myself. My name is Roshun Patel. I've been working at Genesis now for, almost 3 years. Joined in 2018, sort of on their lending team. And kind of my day-to-day job relates to like lending, trading, derivatives, kind of across the business, primarily focused on lending. It's been an absolutely wild growth journey to see. And excited to be here, of course.
Let's get right into it. You work at Genesis, so you probably spend quite some time dealing with sophisticated traditional investors who trade derivatives or equities or whatever in legacy markets. And some of them are probably thinking about dipping their toes into crypto. What are the most common concerns or questions you get when talking to people who trade legacy markets?
I think, if we're, coming from the angle of like someone that hasn't ever touched crypto at all and is kind of involved in other markets, talking to us, like some of the more common questions we hear are the number one thing that I think comes up, especially from like an investment angle, is volatility for sure, especially with Bitcoin, Ethereum. I mean, really anything. The first question is like, well, how do I, think about this when it's so volatile? And then I think the second question is generally around custody, storage, like kind of how that works. Like people hear like a lot of like sort of nightmare stories on the media about like keys and things like that. So they're like, well, how do I ensure that like, I'm holding this properly? Then like sometimes you get some really funny questions like, who's the CEO of Bitcoin? It's like, well, but those are less common, and generally the people we talk to are somewhat informed. I'd say those are the main ones. Then like kind of like how does it trade? Where does it trade? Who's in the market? Who's involved in the market? Those questions kind of come up later on, but I would say the two most common and the first one generally are volatility and custody.
Yeah. I mean, that's definitely still probably one thing that's holding lots of sophisticated players back from actually jumping in full time. I was talking to someone who works at a like pretty sophisticated ball trading shop, and they had issues compliance wise because they weren't allowed to like discuss trades on Telegram, for example. Like compliance just like didn't allow them to use Telegram, and that you basically you can't compete in crypto if you have rules like that. So let's get right into options. We've seen options volumes explode in the last couple of months, and we've also seen some like interesting behavior around options expiries, and especially around the strikes that have really high open interest. Do you think the gamma effects that do move equity markets to an extent, do you think that's also something we see in crypto?
That's a good question. I think in short, I'll say, without commenting on any specific strike, but yes, gamma effects impact spot markets in crypto. With a couple nuances that I think people might, not know right away. One of them is, there can be a ton of gamma supply in the market that comes from sort of like overriding firms and people that, want to sell those calls in a sort of hedge manner. And a lot of that flow definitely occurs like sort of bilaterally over the counter. So like this sort of effect that you would think because like a massive strike was lifted on Deribit at a certain price, there might be a lot less gamma actually there in the real marketplace than what's on the screen. So, that's kind of one way to think about it. And then yeah, I mean, like in this regime, like it's a lot, I think, easier. You're a lot more comfortable being long delta than short delta. So kind of like the gamma effects you see like when price sort of starts going below strike, like that big strike, like a lot of that delta was probably picked up a lot earlier. So like, people aren't really, too concerned about selling it down. Whereas like on the up move, it's a little bit scarier, right? Because like if you go past a certain point in this market, it's like, well, where does it really go? So it's not like equal equidistant from both sides of the strike. And a lot of it is sort of hedged already off screens anyway. So that's kind of what I'd say. It definitely impacts markets, but with a little bit of nuance.
Yeah. I mean, you talked about people being a lot happier being long delta than short delta, which is probably, I mean, the trend is so like incredibly bullish that like, of course, people are willing to overpay for positive deltas compared to being short deltas, for sure. That is true. Let's talk about volatility specifically. One thing that's actually extremely surprising to me is that volatility has actually been quite steadily rising the last couple of months, even though a bunch of institutions have announced they're accumulating spot Bitcoin. That hasn't actually done anything to dampen volatility at all.
Mm-hmm.
That's extremely perplexing to me.
Yeah, no. I mean, the volatility is just like, it's kind of there in the market. I would say there's more of an institutional bid right now. A lot of those sort of holdings that are out there are held in more sort of places where, they're less likely to sell in the short term, or even the medium term, or whatever you want to call it. It's, kind of long, very long for a good amount of time. But at the same time, the amount of leverage you see taken out on a lot of like, retail facing platforms, and a lot of sort of, kind of like the demand, the desire for leverage is always there, especially in this market because it moves so much. And until that goes away, and I don't know necessarily what would cause that or when that would ever happen, but you're going to see a lot of this volatility. And you can't like say like, hey, like the volatility in crypto markets is totally uncorrelated to volatility elsewhere. And as you see volatility there, you should see some reflect here. But yeah, I think a lot of it is demand, desire for leverage, kind of just keeps things very interesting. And people tend to panic when things are down a lot, and they think get very euphoric when things are up a lot. And it's just sort of like a very like spread emotional spectrum there.
That's actually a really good point. I mean, we've seen multiple really big liquidation spikes in the last weeks and months, and all of them got extremely aggressively bought up in spot markets. Do you think that is a sign of the market becoming more fully funded in a way? Because people get liquidated trading on extremely high leverage, and then longer term, like it's a meme, but diamond hands step in and buy it off.
Yeah, that's a good question. I think so. The way I think about that is, so like ultimately yes, in a way, and my reasoning for that is really, like derivatives are net zero sum instruments. Like anyone that's long one contract is losing to a short one contract. Generally, I feel like the people that are making money in trading derivatives, whatever side they're on the derivatives, like, just utilizing them as a tool in this sort of arsenal, tend to roll any P&L taken into spot. Like, so there's like the P&L that's generated from derivatives ultimately ends up in people that are rolling it into spot and are sort of bullish long term. So over the long term, I agree with you there, where it's like, yeah, there's more and more sort of diamond hand holders in these markets, as sort of the people that come in and like throw a little bit on like a single exchange and kind of, see what happens, 50x long, just like disappear, and less of that occurs. So yeah, I think that's a fair point, that liquidations drive sort of inventory to stronger hands, for sure.
Do you think that is going to dampen volatility going forward? That I mean, Bitcoin is undeniably on its way to become a relevant macro asset, for sure. and it's still moving a lot more than any other big macro asset. Do you think as it becomes more and more part of less risky portfolios as well, do you think that's going to have an effect on how much it moves? And do you think it's going to become more tame in a way?
Yeah, no, I agree. I mean, I think you could look at other commodity markets as sort of examples for this, but like, and I don't have the numbers in front of me, so I won't speak to any specifics, but generally you've seen that, you know, sort of markets, commodity markets over time get less and less volatile as they get more and more sort of institutionalized, you know, better venues for hedging, you know, more liquid venues and things like that. So I don't think Bitcoin will behave too differently over the long term. You know, how fast that happens is harder to say, and how, you know, kind of, yeah, exactly, really like the pace of it is really the challenge in terms of how you see it, because in this market there is a lot of sort of demand for leverage and things like that, and you know that's going to keep volatility relatively high until it gets more sort of, you know, put on balance sheets that are going to hold it for a while, not really sell 20 or 30% moves down or up. And yeah, like, you know, people that own more equities and other things, you know, as they sort of add Bitcoin to their portfolio, you know, more and more of those types of people should reduce the volatility in theory. So yeah, I think it's going to take time though. It's going to take time.
Yeah, for sure. I mean, it's definitely on its way of maturing, and it's probably hard to predict when like the timeline of that process is uncertain, but the outcome is something most people who work in the space are willing to bet on.
Yeah,
which actually leads me to the next question. It also kind of a meme. There's been lots of talk about this being the last Bitcoin super cycle, and that the world is moving towards hyper Bitcoinization. Institutions are buying our Bitcoin. Do you think there's some substance to that? And do you think that, for example, I mean, the floor of where Bitcoin can go is undeniably higher than it was a couple years ago, as a result of like long-term investors coming in and accumulating supply. But do you think the super cycle, that it's up only from here? Do you think that that's true?
Yeah, I mean, you know, personally, just, you know, I'm very bullish Bitcoin, just generally like crypto assets and the whole sort of space. As far as like one directional super cycles, that, like, you know, kind of what constitutes that, I guess, is a sort of term there, where it's like, is it like a super cycle if there's not more than like a 10% or 20% dip ever throughout its sort of existence? You know, if that is the sort of requirement, let's say the requirement is like there's no more 50% dips, and Bitcoin basically moves in a way where it doesn't drop 50% ever moving forward. Look, I think it's possible. It's really hard to say for certain that that's like sort of, you know, we're in that regime where like that's never going to happen again. Because at the end of the day, what drives the market are flows, right? It's like, you know, you have narratives and things like that are sort of the macro trend, but in any given moment, it's flow, it's supply and demand, it's order book versus, you know, other sort of traders. And it, you know, it's tough to say whether, you know, you're never going to see a dip like that ever again. Like, you know, something like March of last year. I think the probability, as you sort of establish yourself with more and more sort of controlled rallies and less sort of hectic dips to the downside, I think it's like, you know, that there can be a case to be made that like we're getting into a more stable sort of super cycle bull trend of sorts. But, you know, I think it's you know, you're gonna continue to see some sort of dips, and, you know, that's going to be a part of the market. And I don't think, though, I think the likelihood of like a 3-year long bear market, like the 2018 to 2021, or even, you know, halfway through 2021, that, you know, that one is, I think that's less likely to see now. Like, I would be very surprised if we entered into multi-year bear market from here, you know?
Yeah.
So, yeah.
Let's talk about correlation between legacy markets and crypto. We've kind of seen this on and off regime of crypto following equity in indexes, then it not following it. Do you think crypto is going to meaningfully decouple from other risk assets?
Yeah, so I think, ultimately in the long term, like, the reason why we're all here, the reason why, like, the narrative around crypto, Bitcoin, it in theory it should, at some point, like, personally, I think that, like, it's something where, you're even seeing it right now where it's like, sometimes equities trade weak and bonds are trading weak, interest rates are rising, and like traditional finance is all worried about this. And this was kind of like last week this was happening. And Bitcoin was kind of like sort of holding like a decent bid there. And like this was like Feb 21, the sell-off started, and we like went off from 57 to 44K. And then kind of where we were in like the 40s range, where like what was happening in equities, it was relatively like, hey, like, there's something here where like Bitcoin, Ethereum, like they're kind of like hanging in there despite like utter chaos over here. And then people are like, maybe that's bullish. And then like, boom, we're like, right now we're talking the price is like 58K. So I think ideally, you do see a lot more of that in the future. In a sort of all correlations go to one event where there's like just a flight to dollars, like you saw in March of last year, it's probably going to, be a little more correlated. Like, let's be real. But yeah, in the long term, I think it should behave on its own, and that's kind of what we're all here for anyways.
Yeah, that's true. So you guys at Genesis work with lots of big institutions that are looking to buy Bitcoin. And this might be a bit of a naive and a bit of a sensitive question for you. How do institutions technically go about actually buying Bitcoin? Do they just bid TWAP? Do they buy every time it dips more than 1%? What's the process?
Yeah, no, for sure. I mean, it's a very like sort of unique thing there, where it's like it really depends on the institution's sort of style, what they want to do, kind of how urgent they are about timing versus the market, or like, the price. There's a lot of parameters that sort of clients can give us in terms of how they want to execute trades, and we can sort of structure a process that makes sense in the context of those parameters. Like, whether that's hey, like, I want to buy this really as fast as possible, and like I want you to give me a risk price on it, and here's the risk price, then we'll sort of hedge that out ourselves, and we'll price that appropriately, which is very uncommon. Like, that's not really what institutions do, at least in large size. Or it's like, hey, like, I kind of want to get in on this much with this kind of top, but kind of work it and like take your time on it. That's another way to do it. The other way is like, hey, like I want to stack some limits down over here. Like, I think, if we get down here, I'm a really strong buyer. So that's going to be kind of where I see things. And, you'd be surprised with a lot of these sort of companies out there, they're varying ranges of sophistication, but they're not, they get markets, they get kind of how all these things work. So, you can do like sort of, basically it's like the slower you go, in theory, the lower the price impact you have, the faster you go, the higher the price impact you have. But it really depends on kind of what the sort of overall trend is going to be in that sort of time frame. And you kind of have to be nimble and sort of ensure that you're kind of just doing as much as possible to get the client, or the best price possible on the trade. And there's just so many different ways to do it. It's kind of similar to how you and I would go about buying Bitcoin. Like, it's like there's many ways to do it, and we can choose, and depending on a lot of different parameters and factors, we can pick which one makes the most sense. Yeah.
There's been lots of talk about on-chain metrics and looking at on-chain data to basically see what big players are doing in the space. Do you think that's something worth paying attention to, or do you think there's lots of noise and not a lot of data?
Yeah, I mean, that's a good question there in terms of kind of how useful is the signal for moving or from sort of these like sort of large data providers that say like, watch out, like a bunch of coins have hit an exchange or whatnot. I think there is, the chain is very interesting in the sense that it's like, it's completely transparent in terms of who's moving what large transactions are going on. I think kind of there can sometimes be sort of gaps in understanding between looking at a single transaction based on what was known from like sort of some of these sites versus like kind of what's actually happening, whether it's an internal transfer or a mislabeled address or things like that. So you have to be wary of those things. And I think, that it is possible that there are some sort of, points of confusion there. Like I remember, when was this? Maybe it was like May, or I think it was maybe May of last year, where there was like a sort of thing spreading around on Twitter I won't say the specific source of it, but you can look it up, where people thought like, oh, Satoshi's coins were moving or something like that.
Oh yeah.
And that just moved so fast, and like the market legged down once, like on that news, and like you're thinking like, okay, like and then in all like the sort of circles that we're a part of, like the sort of people that are really on top of the on chain, they're like, this is not Satoshi's wallet, like it's not like it's like it's not a big deal to move on or whatever. But then like the market took like another gnarly leg down. I think it was like trading at like almost 10, and then it went to like 10, went to like 9.7, but then it like traded high 8s for a second, sort of after that second move. So, and I it's hard to say, but like I do think that was the catalyst for it. So you have to be wary about like the sort of groupthink that comes with a sort of viral tweet that could spread on like a sort of exchange movement. And there's two ways to think about that. One is like, like maybe that's like just because it's viral, it's like that's going to happen. It's a self-fulfilling prophecy. The other is, you could be smart about it and be like, oh, it's not real. So it's like, maybe not to like dump your risk or anything. But, after if it sells off, you're going to feel like really silly about it. So, yeah, I think, the on-chain stuff, I think it's sort of, my take on it maybe is like it's an element of like sort of stirring up social sort of commotion on Twitter. And then once that social commotion gets out there, whether it's real or not, that's going to start to have meaningful impacts on prices. So you have to be wary of it. It's not something you could totally like ignore, but it's like to each his own on the style of how you want to choose to think about integrating that into your risk management, right?
Yeah. I feel like there's still a surprising amount of edge in just understanding how Bitcoin and other like chains work fundamentally. I remember, like, I think it was a couple months back. There was like this big, like, there was like a Bitcoin double spend thing going around. Like Bloomberg had like the big title story of like, does Bitcoin have a bug? And like anyone who spent any time looking into how Bitcoin actually works could have dismissed that in like 4 seconds. The market sold off decently considering like there was zero substance to the news. And
yeah,
that's probably a massive source of edge for people like you who actually understand how markets and how technically things work.
Yeah, no, for sure. I mean, yeah, I remember that. That was wild. I mean, it's like it's spreading when like people are like hitting you up, like you're like family and like friends are like, I heard like Bitcoin broke today, and I'm like,
yeah.
What are you talking about? This is not like, and that's like just Bitcoin too. And you like get into like Ethereum too. There are a lot of like papers out there and stuff on that, like the whole mempool, kind of what's out there. Like there's all sorts of strategies, like pretty much, there's all sorts of crazy things on Ethereum that like most people and most like sort of, I feel like news outlets are really not going to be looking at that intensely. And there's definitely a lot of sort of edge in there.
In the Q4 report of Genesis, which is, by the way, excellent. Anyone should read it.
Thank you.
It should be mandatory for anyone who trades crypto.
That means a lot to me.
You talk about the structural gap between the market relying on levered products and actual cash that is deployed to do arbitrage, to basically do the basis trade between futures and spot. It's super surprising to me that relatively short-term futures still trade at insane premiums. The June futures, I think now are like between 20 and 25% annualized premiums.
Yeah, they are.
Why?
Yeah.
How?
Yeah. It's always it's wild, honestly, that the premiums are there, but I think there are a couple of reasons to arguably justify that premium. I think sort of on two sides of the market, you have like the sort of institutional arbitrage shops that are dollar denominated, that like we're going to come in and try to close these gaps and like really sort of make sure that everything's in line with like the actual costs of cash funding in the world globally. And then on the other side, you have sort of demand for leverage, like people that really want to go long these futures, that want to have the convexity of the upside because it's a forward contract, and like all these sort of people that want to that sort of leverage more retail flow that's on there. I think the premium is one of the aspects of the premium is a battle between those two flows. And right now it's really, there's just way more desire to have the delta, to have the upside down on the curve than there is for people to take in the other side of that and be like, I'm bringing this back to earth because, this is how much capital I have to deploy, available to deploy to that. and like, the other flow has way more capital and it's more aggregate, right? It's like less like, you don't have any one given institution that's like really, ripping apart those futures. It's more like a collective market thing. So that's one. I think the other is being short futures, especially in a sort of bull market like this, has a lot of, depending on the exchange, of course, has problems for sure. Like, to be short, for example, CME futures, 40% margin, which is where most of the institutions trade. You have to kind of put up 37 or 40% margin, depending on who you are. But let's just say 37, it's still high. As price goes up, you have to still post that margin, and that's in cash, and they don't even take Bitcoin as collateral. So like they have no idea you're long spot against the short futures position. It can become prohibitively expensive, like, balance sheet ending expensive if the price were to go from, 10x or something like that from here. And it's not unreasonable. It's like, it went from, 6K to 60K. So that margin requirement is sort of difficult to price for a lot of places, I think. So they're a little bit more like, we'll do this much on it, not this much, because we can't really come in and crush it. And sort of like related to that fact is, the lack of sort of very liquid, physically settled futures that have a lot of the open interest. Because a lot of what constrains, I think, large institutions on the future side of like the sort of cash settled ones that are on like the other exchanges, or even Bitcoin settled ones, or sorry, yeah, they're cash settled mostly, not Bitcoin settled, but they're, that the 1 hour that you have at the end, or whatever it might be, whatever the index is that it settles at, it's like if you're really a large piece of the OI and you have to, sell that much spot, you're constrained by how much spot you can sell in that hour to match that index. Even if you're perfectly doing it on all the index constituents, whatever, it's still like a sort of bottleneck. And it's a lot easier for a lot of people to just deliver the spot that they are long to the futures venue, and it's a zero, it just closes to zero. That, I think, you'll see that at some point, physically settled futures. And I suspect that if you see like a very liquid OI physically settled futures contract come to the market, it's going to bring the quarterlies more down to earth, right? And then lastly, I think credit risk of futures venue. It's less of an issue for CME, but obviously there's varying, venues out there, varying degrees of comfort in terms of how much money institutions are willing to put there. There's not like people that have generally like carte blanche on credit risk across all derivatives exchange in crypto, especially ones that would come in and close this gap. So that's definitely a constraint there too. So yeah, I think it's a mix of, those three things: the ARB flow versus the leverage flow, the sort of the credit risk on the venues, and then of course the lack of physical settlement, and then margin. It's a lot of reasons. Yeah. I don't know why I said three.
Yeah. But really good points for sure. Yeah, that does make a lot of sense. Yeah. I've heard that the new Genesis report is going to have a lot of things about options in it. Why is that?
So it's technically we haven't even hit like the sort of last mark date for the data. So we'll see kind of how like it ultimately shapes up after. Like we have like ideas now. We kind of like ping pong a little bit here and there, and then sort of after the Q1 ends, it's like, okay, like it's time to do this. Like let's do it. But I think the derivatives desk specifically has seen massive growth in terms of counterparties and sort of volumes, assets, and just general interest in the sort of product. We've grown out the team. It's much bigger now. It's doubled in size, so that's good. And I think it's tied into so many of the other flows and sort of lending activities and things like that. And we have a lot of really sort of easy ways for clients to sort of settle between our trading, lending, options entities, things like that. So, or desks. So it's we get a lot more of the flow now, and it's a lot more sort of easy to see, and it's there's going to be a lot on options for sure. So I think it's just because it's a growing market, and also we started the options desk in May of like 2020. So we were technically, I think, a little bit behind at that point in terms of OTC options, because like other people were definitely doing it. But now we're like kind of in the market. We're we want to like make a little bit more of a splash in terms of talking about it. So yeah, we'll see kind of how it ultimately shakes out. But there'll definitely be a lot more options playing there for sure.
Yeah. You talked about growth at Genesis. How has that been for you? Because I'm not sure about the exact numbers, but you grew at some insane clip this year. I think trading volumes are like up 350, 400% or something, some insane number. Your job must look different than it did 12 months ago, I would imagine. How's the experience of seeing the incredible growth? How's that mean for you?
Yeah, I mean, first and foremost, like it's awesome. Like it is at the top level. It's extremely exciting to see, like just the sort of clients, the people you're talking to, everything that you're doing on a day-to-day basis. There's just like a lot more size to it. There's a lot more sort of establishment to it. Like in like 2018, it's like, hey, like, I'm gonna do something in Bitcoin lending. It's like, what? It's like, is that a thing?
Get a job.
Oh yeah. Now it's like, oh, that makes sense. Like, cool. So there's a lot more, like, it's a real rewarding there. It's like, a little selfishly, it's a little bit validating for sure, where that's awesome. Obviously, like work-life balance, like especially with COVID and the remote, like it's more sort of, you have to manage it a little bit more for sure. But overall, like it's been an absolute great journey. It's awesome to like see all the new people coming on the team. I'm sure you guys see the same way at Deribit, where it's like, you can like talk to all these great new people and like kind of bond with them and chat with them about markets or what you're seeing and the desk and all these things. And I think once, it's nice to experience that growth too, like physically with people too. So once things start to open up in New York again and London, where we have another office, and Singapore too, it'll be awesome to like, have a little more camaraderie there and things like that. So there's a lot to look forward to, and it's been an absolute great time looking back for sure.
Yeah. One of the things I really like about crypto is that it's such an open space. Like everyone is willing to talk to everyone. That's probably been your experience as well, right?
Yeah, no, it's crazy. I mean, like a lot of people that are in like, there's a balance too, for sure. But generally, like a lot of people that are, more in the traditional finance space, it's like very cutthroat. It's like everyone you're talking to is trying to like outsmart you and like, be better than you and whatever. In the crypto market, there is a little bit more of like a friendly sort of vibe to it. It's like to the pace of the conversation, like everyone's sort of growing together. It's only a zero-sum game for everyone if there's like no growth and this is what it is. But like as the sort of volumes overall grow, because the prices are overall growing, there's just a larger pie. There's like, there's a lot going on there. So it's like, even with our competitors, it's like we're not like sort of like, super cutthroat or anything like that. We talk to them, we chat, we meet up prior to COVID, and hang out or whatever, and do social things after. It's very nice. It's very refreshing. I say refreshing. I wasn't really, it's not really refreshing for me, but it's good to have that. Sort of throughout. Yeah.
You've obviously been into crypto for a really long time, so you've seen all the boom and bust cycles, and you've seen how markets behave and how they trade on a micro level as well. Have you seen any changes in the last months, years, in how Bitcoin and Ethereum and maybe the majors in general, how they trade on a micro level, like how flow works, how aggressive the bid is, and those things?
Yeah, no, for sure. I mean, you go through sort of regimes on a lot of this stuff. Like I think one example of one where it's like, I think, overall there's definitely been change. And I think a lot of it is like, right now, especially in a bull market, there's a lot more there's a lot more opportunities for like, if you're like a high frequency market maker or something like that, to like get a lot sort of, better returns or better sort of, like just more like lifting going on, like whether it's, on the bull side or more hitting the book, just generally more takers, I would say. Like an example of when markets were like just really weird, it was like in that 2018 period, after we like the last time we like were, kind of hovering around 6K, like we were at 6K forever. Like, there was not like, it was like, you're like a $300 range for like multiple days. There's just no volatility. It's like, what are we doing here? Especially on like the trading side of the business. It's like, it's like not many people are really trading that. And then just bam, one day, like after that, like BCH BSV fork, it just nukes to 3,000. It's like, okay, well, just all that volatility came in one sort of isolated spike. So like the way that it was, like, I think prior is like, it was sort of like volatility was like a skyscraper in the desert, right? It's like it's not really there. And then when it comes, it just like comes out of nowhere, and it's just like really gnarly and it's really brutal. I think over time, what you're seeing is more of like a stable, like volatility is there, but it like sort of ebbs and flows in a much more sustainable way. It's not like super quiet and then super crazy or anything like that. It's generally like a more consistent level of volatility, more consistent taking in the marketplace. And I think, the proliferation of derivatives definitely changes the pace of the way people do things, for sure. Like, sometimes you see like sort of offsetting flows in derivatives markets versus spot markets. Like you see a lot of buying in spot market, but there's also like a lot of puts bought on that same sort of instrument. It's like that's a bearish derivatives play, a bullish spot one. Like which one's going to carry out the sort of fundamental move? Let's say it's spot. Now the effect of those derivatives positions sort of compounds into spot, and you see sort of that move. So yeah, I would say like that. Those are kind of like the general themes I've seen over the course of the past couple of years, just observing markets and in a sense of things, for sure.
Yeah, it's probably just a sign of like a maturing market in general, right? I mean, derivatives volumes are rising steadily, especially the option side. So people can actually hedge efficiently and can actually speculate, like using more sophisticated structures for it, and that probably does like make spot more well behaved to an extent, I would imagine.
It's a double-edged sword. It's more efficient, it's better, it's more stable, it's good for sort of the longer term investor, but for the traders, they're gonna have to adapt and move forward just like they did in every other market out there. So yeah.
Is that something you guys worry about, that the market overall is getting more efficient and there's definitely more players entering the game? I mean, lots of big OTC desks do crypto now. I think Morgan Stanley just announced they also going to do block trading for their clients. That obviously, like the pie is still growing massively, but at the same time, there's a bunch of extremely sophisticated players getting into the game. Is that something that concerns you?
No. I think the entrance of a lot of these sort of like traditional finance incumbents into the space is a very good thing for crypto generally. I do think also like, it's gonna be tough for a lot of people to, well, we'll see how it works, but a lot of like the clients that you have in or the people that are in crypto are, they are going to trade where, they have everything. There's a good user interface. There's a good, sort of repertoire that they've had for a while. Like it's going to be tough for a lot of these sort of incumbents to win over a lot of the sort of big people that are already in crypto. Sure, they can, sort of create their own sort of existing clients and bring them into crypto, which is good for the space overall, because those people were never in crypto to begin with. So I think, in that sense, it's extremely bullish. And I know, we talked about the whole pie growing thing too, but like the nature of these sort of institutions and traditional sort of places that are coming, they're dealing with a fundamentally different asset class here. And it's rare that you see like a sort of fundamental change in how an asset is actually held. And I think that's the most important thing about anything at the base level. It's how is it custodied? And it's like, well, it can be bearer. It's like very, it's going to be very interesting for the conversations they have if like, clients like, I want you to send my Bitcoin to my wallet and I want to go like, do something with it or whatever, they're gonna have to deal with that. And, kind of creating an ecosystem around a bearer assets is going to be, it's going to be interesting for a lot of those incumbents, as well as even, us, it has been, but, there's a lot of that. And then lastly, I think, you're talking about Generation Z, right? Like let's talk about like the sort of people that are younger than us and are sort of, they're going to inherit a lot of money. They actually have a lot of their money. A lot of them are making money in good, interesting ways online and doing the sort of things, the way they view sort of counterparty risk and sort of reputation, things like that is a lot different than you or I, or even definitely people above us, where they're more comfortable, I think with just like something like a smart contract or like a sort of, well-known crypto entity name, insert whatever it might be here, rather than like a bank or something like that. So, that element of counterparty risk sort of mentality is different through generations. And I think that's going to have some sort of, it's definitely going to impact the way a lot of these incumbents enter and deal with the space and how big they grow relative to what's actually out there.
Yeah, that's a really good point. I mean, there's definitely like still a gigantic generational gap between younger people and older people and how they think about money. And I mean, that is going to manifest itself in markets eventually, for sure. Because I mean, people who are 16, 17, 18, 20 now are going to be 40 in 20 years, and they're going to run businesses and invest money, obviously. Like,
yeah, exactly.
So
yeah, exactly.
So one closing question we ask every guest is, what is the most interesting thing you've learned in the last little bit in markets or in crypto?
Yeah, that's it's definitely there's a lot of ways to go with this, and to pick one is like relatively, it's tough, but I do think, and this has been like a sort of long-term realization, I think one of the most important things I learned is that sort of market structure matters a lot to any individual investor. Like, and it's sort of, sometimes it's something that you don't think about, but it is very important to be aware of it, and to sort of like, be able to work well in that market structure. For us, when we started lending, let's say, cash against Bitcoin collateral for the first time, when we started those loans, like, there was no origination fee, there was no sort of closing fee, there's no like sort of random this fee, that fee. The Bitcoin collateral, doesn't have like some sort of custody fee associated with it. It's like very straightforward. It's like only interest rate, and the market structure is very transparent and open, and like there's other sort of markets out there, in terms of, at least in terms of debt for sure, that are like way more complex and convoluted and things like that. And like, I think over time, what happens is like simplicity and transparency sort of trumps sort of like convolutedness and sort of like edging, sort of extra P&L and sort of shady ways out of people. And that sort of like market structure that you're participating in matters a lot. And then it's like, like, even if you like, a more recent example of this, and this is something that came to realization for me even this year, it's like, when you buy a stock in your brokerage account, like, kind of, where is that held? What is the brokerage account doing with it? What sort of interest rate are they charging people that are short this product? And is it coming back to me in any way? All these sort of questions are coming to light for people, and they're like not realizing that, like, they're realizing that like things are not like, sort of equal or sort of like one-to-one with maybe their expectations and things like that. So like the structure of the market is like maybe different than what they thought. And I think one of the things about what crypto does well is it's generally very transparent about market structure. It's very upfront about how it works. Like, when you do an OTC trade with Genesis, the price you get is the fee. Like that's it. It's just like the price is all in. Like, if you buy this at this, it's, the wire is that same amount. There's nothing different about it. And with a loan, it's just an interest rate and things like that, a lot of that sort of element. And then, you go to DeFi, and it's a whole nother game of whole nother level of like sort of openness. So I think that's the main thing I've learned in all these years. It's just market structure is super important, and understanding it and the nuances of it is very
perfect. I think we got through everything. So thank you so much, Ro, for joining us today. Absolute pleasure to have you on, and have a great day, and hope to see you again soon.
Thank you. Yeah, no, this was awesome.